I'm David Bank. From Impact Alpha, this is Agents of Impact, our series of interviews with change makers in and out of impact investing.
The role of development finance institutions is to step forward, be counter-cyclical, provide funding and liquidity at a time when commercial investors wouldn't. And of course, that means you've got to take a significant amount of risk to do that.
That's Nick O'Donoghue, CEO of the CDC Group, the United Kingdom's development finance institution. Let's jump right into our conversation. Welcome, Nick.
Thank you, David. Nice to be here.
The CDC Group is not the Centers for Disease Control. It is actually formerly Colonial Development Corp. Isn't that right?
Well, originally, when the organization was founded in 1948, it was actually the world's first development finance institution. And really, in our view, the world's first impact investor. But founded in 1948 as the Colonial Development Corporation, you're right. In the late 1950s, we moved from being the Colonial Development Corporation to being the Commonwealth Development Corporation. And then sometime in the early 90s, we moved from the Commonwealth Development Corporation to CDC. But you're right, you're absolutely right to say we are always confused. And particularly now, of course, the Center for Disease Control is so often in the news, and we are always, we are often confused with CDC. And now, indeed, there's an African CDC. There's also an African Center for Disease Control. So we're also regularly confused with that one. But we are CDC, formerly known as the Commonwealth Development Corporation and the UK's Development Finance Institution.
Excellent. Thank you. Well, I'm delighted to have you. You have been sort of everywhere and know everyone. From Goldman Sachs to JP Morgan to Sir Ronnie Cohn and Big Society Capital to the Gates Foundation and now the CDC. And so I'm delighted to have you to talk about what I think the common thread that seems to be coming through a lot of conversations lately is risk, and how as investors you can price and underwrite risk, and how all that is changing in the face of global crisis, obviously COVID, but also climate, and I would dare say kind of uprising against inequality and injustice. And so I'd like to get your opinion on all that, but let's also just get you situated first, because I said you've been sort of everywhere. All of that gave you purchase. You had a very nice column in Impact Alpha a few months ago, putting some questions to some of your old colleagues at JP Morgan about their development finance institution. And you were sort of wondering sort of where impact would play. Did you get any response on that?
I did get a very detailed response, very helpful response from JP Morgan within about 48 hours of that article appearing. So they were, very constructive and I think open response, which I was impressed by.
Nice.
I was impressed by the impact of Impact Alpha as well, that it got such an immediate response.
Thank you for that. So now also just tell us a bit about CDC. You introduced the history a little bit, but you got like $5.8 billion portfolio, at least as of some website posting. I don't know how things fare in the market, but that's about $6.5 billion US, and you invest about $1.5 billion a year. Which, if you were a private equity firm, classic type, that would be a pretty large fund to be putting out $1.5 billion a year.
Yes, and CDC, as I said, is the UK's development finance institution. So we're 100% owned by the UK government, specifically by the Department for International Development. We've been around. We were, as I said, the world's first. I mean, nowadays, almost every developed country has within their sort of development family of organizations, they have a development finance institution. In the United States, that's the organization formerly known as OPIC, now known as the IDFC. And then you have organizations like FMO in the Netherlands and DG in Germany. So we're part of that family. But we were the first development finance institution. And we were founded originally, the original chairman of CDC was a gentleman called Lord Reith, who's very famous in the UK because he was the founder of the BBC back in the 20s. And then he was the first chairman of CDC. And he said that the role of CDC was to do good without losing money. So we were set up to make investments, preserve capital, recycle capital, but at the same time have a positive impact at that time in helping what were then the Commonwealth countries to sort of redevelop after the war. So that was the origins of CDC. And then, like most organizations, and particularly politically owned organizations, we went through a number of iterations over the next 70 years. But in the last 10 years or so, we've set up very much like a traditional development finance institution. We're different for a couple of reasons, I think, from some other countries' DFIs, partly because our investments are restricted only to two regions, so Africa and South Asia. So everything we do, all the investments we make go into one of those regions, Africa. And Africa, within Africa, it's mostly sub-Saharan Africa, and then South Asia, it's India and the neighboring countries. So quite geographically focused. We invest in a core sort of six or seven different sectors, and we are a development and impact investor. Where every investment decision we make is made principally because we think it'll make a difference to people's lives on the ground, and secondly because we think it'll help us at least preserve capital, and make a return so that we can recycle the capital. So that's we are, as you said, our balance sheet's about $6 billion. We now investing. We've grown significantly over the last decade or so, and so now last year we invested actually $2.1 billion, of which about $1.4 billion was in Africa, and the other 700 million was in South Asia.
Well, let me just press you a little bit. You said do good without losing money on the one hand, and then everything done for a development or impact purpose on the other hand. Does that make you? Where does that sort of place you on the spectrum of sort of risks and returns? Are you sort of more commercial or more
Yeah.
concessionary?
Mm.
How do you think about that?
Yeah, I think DFIs in the past have been labeled as being too sort of overly commercial or too like a commercial investor. I think that has changed over the last 5 or 10 years. But essentially, at CDC, the way our shareholder has set us up is we have two separate portfolios, and one we call the growth portfolio, and that's more like a traditional development finance institution. It invests in a lot of infrastructure, provides a lot of financing through banks, invests in, we have a large proportion of our money invested in equity. That's the other thing that makes us different, and in private equity and private equity funds. And we try to do that obviously at reasonably, for many of them, in common with many of the other sort of newer impact investment firms, we'll try to do it at a reasonably commercial rate. So that's a part of our portfolio. But our required return on that portfolio is 3.5% in sterling. Now, over the last 7 or 8 years, we've earned something closer to 6 or 7%. But you would probably say that's not commensurate with the risk, with the level of risk we're taking. But that's one part of the portfolio. The other part of the portfolio is what we call catalyst, and there's been a lot of talk and a lot written about catalytic capital over the last couple of years. And CDC probably has one of the largest catalytic capital portfolios, about $700 million. And the target of that portfolio is to really take additional risk in return for enhanced impact. So it's allowed us to do a lot of things that our traditional growth portfolio wouldn't allow us to do. The intention, I mean, the intention is to try to break even with that portfolio. But realistically, given the levels of risk we're taking, that's a challenge. But that's sort of what we aim to do.
Well, so you've sort of walked right into my risk
Mm,
question here because you've sort of hit the nail on the head, which is that risk adjusted is really what we're talking about. You said in the main portfolio, you think you're possibly taking more risk
yeah,
than you're compensated for at some level, and that in the
yeah,
catalytic portfolio, you're actually looking for things that are riskier if you can get it back
that's right.
in impact. So are you're sort of underwriting risk in both
Yep,
cases, and I guess
yep.
in a sense taking on more risk than purely commercial investor might.
Yeah, no, I think, look, if you're our investment portfolio, the places that we invest, the countries that we invest in, are, we like to say, we do the difficult deals in the difficult places, and we really do go to some very sort of out of the way places. But we are within Africa, within sub-Saharan Africa, we believe the largest equity investor in sub-Saharan Africa when you look across our direct and our indirect portfolio. Africa's been a difficult place to invest particularly over the last 5 years, but from a cyclical perspective. But when you look at our returns, or you look at benchmark returns for equity investment in Africa, you'd have to say that they're not consistent with commercial risk-adjusted rates. And that's the reason why, if you look at Africa today, and if you look at who's investing there, particularly who's investing equity, there are very few commercial investors who go there. The only people doing it are the development finance institutions, people like CDC, people like the IFC, people like the IDFC, who are still going there for developmental reasons, and to a small, but I suppose increasing extent, some of the larger impact investment firms
Well, is that
or some of the larger impact investment funds. So the TPGs and for example, have made a TPG Impact Fund Rise has made a couple of investments there.
well, but is that a function of the current crisis, or did that predate the crisis? And how has the
No, I
crisis
think
affected it?
well, the crisis has made a risky area even more risky. But no, it predates. There was a period, again, if we're talking about Africa, there was a period around sort of 2013, 2014 where commodity prices were rising, oil prices high. I think there was a lot of enthusiasm, the sort of economist cover Africa rising type story. There was, I think, a real sense of enthusiasm around Africa. But once the oil price broke, a lot of that enthusiasm dissipated. Returns certainly on equity in Africa have been very disappointing over the last 6 or 7 years. Now, how much of that is cyclical, and we'll sort of see a recovery from, and how much of that is more secular, because it's difficult to invest in countries where the infrastructure is so poor. There are clearly significant governance challenges. There's a shortage often of human capital to really build businesses. So, I mean, it's a difficult place to begin with, but that's been reinforced by the cycle over the last 5 or 6 years.
Okay, so you have that cycle, as you said, and then you have the current crisis making a risky
Yeah.
area even riskier. And
Mm.
you also said that development finance institutions like CDC are some of the few that have stayed in. And
Yeah.
you also said that development finance institutions have taken higher risk or become more impact development oriented, put it that way, over the last 5 or 10 years. Putting all that together, are you taking higher risk? And what do you think about the need to take higher risk in the context
Yeah.
that we're in?
Yeah. Well, I think you have to take higher risk, and you particularly have to take higher risk given the context of the COVID crisis and so on. And one of the having been, obviously, as you said earlier, I spent a lot of time on my career really. The first 25 years of it was in the commercial investment banking side. And what you learn when you're on the sort of when you're in the commercial investing, when something happens, when an event happens, like COVID, or like the global financial crisis, um, or 9/11. I mean, when these things happen, the immediate response of the commercial investment world is to try to reduce risk and mitigate risk. And the way they do that is naturally to pull money away from the places that they know least well, that are the furthest away. And so that's what's happened once the COVID crisis really broke in March, again to Africa. Commercial investors, we talk about commercial investors, we're talking about funds, we're also talking about banks, big, large banks, pulled capital out of Africa. And the role of development finance institutions in those circumstances, because we're set up specifically to be developmental. So the role of development finance institutions in those circumstances is to step forward and fill that gap and be counter-cyclical. So that's what we've been trying to do. That's what the IFC and others have been trying to do. As liquidity disappears from those markets and those countries, and remember, these are countries where they don't have the government sort of resources to provide the sort of support to companies that we do here in the UK or you do in the US. So it's critically important that the role of development finance institutions is to step forward, be counter-cyclical, provide funding and liquidity at a time when commercial investors wouldn't. So it is our job, and of course that means you've got to take a significant amount of risk to do that.
Well, it would seem so, because I mean, in a sense, you're saying, businesses are saying we need to invest to to reopen. Just to say that, I mean, in a simple case,
Yeah,
and yet at the very time we need to invest to reopen, our revenues have been slashed to nothing for months, and so we not
yeah,
only are in a worse position than we were before the crisis, but our revenue prospects might actually be worse than they were. Now, in some cases, they might be better if you're making something
yeah,
that's needed or what have you. But
yeah,
they're certainly different, and it's kind of a systemic risk, I suppose. It's not really It's not really
yeah.
specific to that company, but yet for a lender or an investor, the risks obviously are higher. So, do you make who pays for that risk? Does the entrepreneur or enterprise have to sort of bear the risk and pay a higher interest rate,
Mhm.
for example, to get that loan?
No, I think again, the role of development finance institutions don't exist to maximize their portfolio return or indeed their portfolio risk adjusted return. Development finance institutions are really truly impact investors. They exist to help support development, to support the private sector in poorer countries, to help companies grow, to help them create jobs, and at a time like this, to help them stay alive, because the effects in Africa have not been dissimilar from the effects in the United States or the UK. Business stops. And when business stops, you have this working capital, this immediate working capital gap in many companies. And either they find a way to fill that gap or they go out of business. And hence jobs are lost and so on. A recent McKinsey study highlighted the fact that in their view, Africa is going to lose 10 million jobs as a result of COVID. That's in the formal sector. And then you've got this probably 100 million jobs in the informal sector. So yeah, and we call it, you mentioned it's sort of a systemic issue, and we call it, the key part of our COVID response program is around, we call it systemic liquidity, because that's what it is. It's not a function of the fact that these companies have been performing poorly or poorly managed. It's a fact that there is no liquidity in the market. It's also particularly pronounced um, in many countries because of a shortage of dollars, a shortage of hard currency. So it's not just that liquidity is tight in the country. It's just many companies in the country, in order to survive, they need to import, which they need to pay for in dollars, for example. So they need a supply of dollars, and that's the other thing that development finance institutions do. They bring liquidity, but they also bring, importantly, dollar liquidity. But from a we are, and clearly we try to do it in a way that's prudent. So we try to balance our risk. All the development finance institutions are expected to at least preserve their capital, ideally earn a return, and we're supposed to do that really across good times and bad. So that means you do have to approach this in a prudent way. But effectively, what we're doing is we're taking a lot more risk for a lower, we hope a positive, but a lot lower return.
I saw you did a guarantee for with a banking facility with Societe Generale,
Yep.
and are you bracing or expecting some losses in those kind of deals?
Yeah, you have to be prepared to have losses. But I think historically, what you hope will happen if you take a bank like Societe Generale, it has a particular strength in West Africa, Francophone Africa, the part of Africa where they speak French. They have very good. I mean, they will take our money or with our money, and they will use it to lend to some of the local banks in some of these countries, in West Africa, and that in turn will be lent so they can for trade finance and trade loans and that type of critically needed basic working capital. And you hope, because the loans in this particular case, the loans are relatively short tenor. They're normally backed by some sort of trade receivable. So historically, those type of loans, even during the global financial crisis, have shown very, very small losses. So you hope that will continue to be the case, but it's certainly, somebody has to do it. Otherwise, these companies will not have the liquidity to survive, and jobs will disappear. But it's clearly there's significant risk involved.
You mentioned systemic risk, and the other great systemic risk, of course, is climate change. And I'm wondering
Yeah.
whether the experience of the pandemic has changed the way investors think about other systemic risks that have been also predicted over time and are increasingly coming to bear, but that maybe haven't been, as you say, priced into the marketplace. And I know you guys just did
Yeah.
a big announcement about your own climate plans, and I
Yeah.
wonder whether there's a sort of systemic risk mitigation aspect to that plan, but also more generally how you think about, whether the systemic risk of climate change will actually be a driver of investment.
Yeah, I think to a large extent, climate change was obviously visible. The risks of climate change were visible before the COVID crisis happened, and they've been visible obviously for a number of years now. Um, but there's no doubt that we, as you said, we launched our climate change strategy last week. and it's focused on making, sort of turning CDC into not just a development finance institution, but really a green development finance institution. So we've made a specific commitment to net zero by 2050. We're focusing much more on resilience and adaptation as part of our overall investment portfolio. We're focusing much more on providing support for what we call a just transition. So allowing people to transition and jobs to transition into a new and greener economy. But when we make investments, we have an investment portfolio already that is largely renewable. About $1 billion of our $1.7 billion of infrastructure of power, for example, is renewable power. But there is still some part of it some part that's hydro, but then some part that's still gas. So obviously, those you have to look at the risk profile of those investments very differently, because ideally we will be able to transition. Every country will be able to transition off to exclusively renewable power. I mean, we're not there yet, to be fair, but hopefully over the next, certainly between now and 2050, we'll be able to transition exclusively to renewable power. So the assets, if you own assets at the moment that are power, for example, that's fossil fuel driven, I mean, those are going to be stranded assets, and you have to reflect that in the risk that you're when you think about the investment.
Well, let me just, sort of bringing this all together, get your sort of broad take on, you've talked about the risk of whole sectors and economies shutting down in the COVID shutdown. You talked about obviously the risks in climate of broad disruptions. Are investors in general, impact investors in general, and CDC Group in particular, responding with the urgency commensurate with those risks and even opportunities?
Yeah, look, I think I mean, are we as a society responding quickly enough? I think is a really fair question. I mean, a lot of people would say no. That's why we have a climate emergency. I think there has been, when we talk about investors, well, particularly impact investors, development finance institutions, there has definitely been a sea change over even the last 2 or 3 years, I think, in terms of sort of greater understanding of the climate emergency, awareness, and a commitment to do something about it, to play an important part in doing something about it. So in my time, 3 years at CDC, I think it has been, when I got to CDC, it was, I'd have to say, to be fair, a peripheral issue, but it has become totally front and center in our investment process over the last 3 years, and the launch of the climate strategy was a combination of that. And that means every single investment we make, 3 years ago we might make an investment in renewables, for example, because it was a sort of an attractive thing to do. But nowadays, every investment that we look at through a climate lens, as well as our developmental and obviously financial lenses. So it's a very different perspective. And we have, in part, one of our commitments in our climate strategy last week was to get, both on a portfolio basis, to get to net zero emissions by 2050, but importantly on each individual investment that we make to justify it based on getting to net zero.
Um, Last question, Nick. I know 10 years ago you were part of the team at JP Morgan at the time that wrote the sort of seminal first kind of sizing of the
Yeah,
impact market and predictions
yeah,
for
yeah.
2020, which we've now arrived at.
Mm.
How are we doing?
Well, thank you for asking that question. We did indeed. It's almost 10 years ago in October, and we published this report along with colleagues from the Rockefeller Foundation, and with the help of Jin. And yeah, we at the time we called it impact investing in emerging asset class, and everybody went what, because there really was no awareness of the term impact investing, and it had only recently been sort of developed. So it was, I suppose, seminal from that perspective, and it was the first time a major institution had sort of put that sort of word out there, concept out there. But at the time, I remember and I mean, I think our analysis would look pretty flimsy now, to be honest. But we figured that you could end up over the next decade with somewhere between, I think we said 400 billion to $1 trillion of impact assets. And at the time, well, first of all, everybody sort of looked at the higher number and said that was crazy, couldn't happen. And of course, today we are, by some estimates, the IFC estimate, for example, is over $2 trillion. Um, and so we feel pretty good about uh, um, about that call, basically. And I think COVID will be another accelerator in the same way the global financial crisis was. I think it's going to be another great catalyst for mainstreaming impact investment and mainstreaming the idea that every time that you invest capital, you should be asking yourself not just about risk and return, but risk, return, and impact. And that has the potential to have a massive change in the world that we live in. So it's pretty exciting, and it feels like a long time ago, 10 years, but actually I think we're just sort of beginning really in terms of this movement.
Well, thank you, Nick. Risk, return, and impact. Nick
Mm,
O'Donoghue,
mm.
CEO of the CDC Group in London. Thank you very much for being with us.
Thank you, David.
That's going to do it for this episode of Agents of Impact. You can read more about Nick and the CDC Group at impactalpha.com. Subscribers to Impact Alpha receive our daily email brief, including deal flow, job postings, and original features, as well as full access to impactalpha.com, Agents of Impact conference calls, our members-only Slack channels, and much more. Go to impactalpha.com/subscribe. Thanks again to Nick O'Donoghue and to our producer, Isaac Silk. I'm David Bank, editor and CEO of Impact Alpha. See you again soon.